before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice. Welcome back to the Loonie Hour, episode 12. As always, we're accompanied here with the great pleasure of everyone's favorite boomer, Keith Dicker with IceCap Asset Management. He's wearing his new Christmas sweater. Was spoiled this year, clearly. And then we've got Rich Diaz, the Tom Brady of macro, with Acorn Macro Research. Looking, he's still at school there. But Rich, you're still overseas. Where are you at right now?
I'm in Portugal. I'm in my mom's hometown. It's called Serra Sant Antonio, and it's a quite poor, quite rural farming village in the mountains, sort of a nature reserve up in the mountains, and it's absolutely beautiful. I love it.
You're bringing the macro to Portugal, the fine Portuguese people.
I'm getting in the way of my uncle as he tries to farm some cattle and some goats and some pigs and stuff, and I usually just get in his way.
Rich has decided to start living off the grid. He's sick of all this COVID stuff, so we've lost him for.
It looks to me, Rich, like you're in the high school locker room from that movie Porky's back a few years ago.
Keith, I love that film.
I know, it's funny
film
stuff,
from
right?
the 1940s or what? I've never heard of it.
I think
it would be canceled before it even hit the theaters, but it is wholly inappropriate, extremely sexist, quite bigoted, and absolutely hilarious. And I would recommend everybody to see it.
All right, there it is. Your first recommendation of 2022. Yeah, everyone bear with me here. I've got, I don't know what, a cold or potentially COVID. We'll find out soon enough. But that kind of brings us to, we talked about on last week's show, we drifted into a little bit ever so cautiously just on how governments would react. Rising COVID cases, it's all about the case count. It's not about hospitalizations, at least in the government's eyes. And our beloved Canadian pastime, every Christmas, every Christmas holiday, New Year holiday in Canada, I always enjoy the World Juniors. And of course, that tournament, if you're not familiar with it, was actually, they started it, got 2 games in, and then just outright canceled the tournament. So just kind of goes to show you that that's kind of what we're dealing with right now. We're seeing all these events canceled, flights. I'm in Palm Springs right now. A whole bunch of flights, actually, they're having a hard time staffing pilots and crew because everyone's coming up catching COVID and everything, and having to go through these quarantine measures. And so it's actually, I think I have cousins that are here right now, and they had to change their flights last minute to try to get out of here because everyone's just canceling flights. And of course the CDC, Rich? They just changed their quarantine time now from 10 days to 5. So, and you can see like the sports leagues now, the NHL just adopted that as well. Because everyone's just, they had to bring in like new taxi squad rules. You can add players, and they've cut the time down to 5 days for ASIM. So this is definitely something that we're kind of dealing through here. I don't know if you guys have any opinions, at least from additional opinions here as things have progressed since our last episode on how this will play out from an economic standpoint and central banker standpoint, etc.
Yeah, I'll go first. So first of all, it's playing out exactly the way that we thought it would over the last few weeks. We're increasingly getting more shutdowns, or socially it's becoming unacceptable to do certain things. And it's in the psyche here. As I like to say, I'm here in Nova Scotia, and people love COVID here. They're all geared up to follow all the rules, and that's great. I mean, you want to make sure you keep people safe, but it's overriding everything. I think that's one of the reasons why Rich decided to stay overseas for a while. But I think that we all know, though, what's this now, the 4th wave, 5th wave? I don't know what it is, but this will be over in a couple of weeks. Cases will peak, and cases is what's most important to everyone with this conversation. So, I think the worst is almost, we're hitting like the trough of it right now.
Rich. Yeah, no, Keith, that's a good point. I mean, Rich, you're the data guy there. I know you've been tracking it, I think, globally. I mean, do you have any sort of insights for any of the listeners? I mean, I think South Africa, I think, is reporting a drop off in case count. I mean, hospitalizations still haven't moved as far as I'm aware, but I don't know if you can update us. Anything you're seeing?
Yeah, I mean, all I can say is the vaccine works, and cases are a bad KPI. Not to beat a dead horse or one of my uncle's dead pigs, but the case counts are skyrocketing in Canada, as we've talked about quite a bit. But the deaths, not to be morbid, but are falling. And crucially, the hospitalizations, which have ticked up slightly, remain extremely, well within any normal range of the past, X amount of months, and getting into 2 years now. As far as South Africa, I don't really know too much about South Africa. Sorry, it's not on my radar, but I do have a friend who's South African. She's lovely, equity analyst actually from Old Mutual. There's a free plug for her. But they've sort of stopped all those restrictions. They burnt through the economy and burnt through the country, and it was actually not as bad as people had anticipated. And she's sort of back to normal. But keen to get the booster, and people are still taking some precautions. But I think that it's just a different sort of mindset. I think emerging markets have a much more stoic, much more holistic approach to risk and death, and don't have the privilege of a central bank to bail out their government. So,
hey guys, did you see the? That's true. Did you see the report or the analysis came out? It was comparing Sweden to Austria. Did we talk about that last week? I don't remember.
I don't think so.
No. Did you guys see that report that came out?
No.
So the real short version of it is both countries have about the same vaccination level, like 72%, 74, or something like that. One country, though, decided, we're going to, protect the vulnerable. Everyone else, get on with it. And the other country went to the extreme and said, hey, we're shutting down everyone. And I think Austria may have also introduced the probability of even getting prison time if you're not vaxxed and things like that. So one European, and they're very similar in terms of density profiles for population and all these different things. So the outcome of that is their COVID exposures and deaths and everything like that. They're very similar. There's not a big difference between the two countries. So here's one that's locked everything down or locked it up, and the other one that hasn't. And it sort of ties into like one of the other articles I saw this month. I think this was in the New York Times. They're talking about like the increase in mental health for a lot of high school students. I know here locally there's been some suicides and like just horrible stories and all these negative knock-on effects that are happening. But again, like we're not considering that the current solution may not be the correct one to make. But again, we keep going back to, hey, what are policymakers going to do? And
they're going to ignore they're going to ignore all of those
the cost benefit analysis.
Yeah, of course.
Yeah. But here in Nova Scotia, you sort of got the impression last week that the government's trying to pivot a little bit. And, there's now suggesting, unless you have symptoms, you don't need to get one of those rapid tests done. They're sort of trying to walk it back a little bit. Now they've gone so far out there, it's pretty hard to make the turn. But, that's where they're headed with it.
One of the things, just to kind of quickly touch on that, the one thing that I have really come to appreciate, especially as I went deeper down the sort of finance space many years ago, but people in finance, like Rich, Keith, you guys are responsible for essentially managing money, right? You're Rich, you're providing advice to people so they can use that advice and research to make money. And people in the finance space, you're basically almost forced to be agnostic. Like if you actually care about like protecting and preserving your client's capital, like you basically have to seek out the truth. and figure out how to basically make money off of that. And so that's the one thing I've always come to appreciate is people in the finance space. Like, you almost have to keep your politics out of it, and you just, if you say, okay, this is the wrong decision, they're overreacting, you can just opt to go short or whatever along. Like, you can just, there's so many ways to sort of make these bets. And so that's the one thing I've always come to appreciate. Like, I subscribe to a lot of independent research, and it's for that reason. It's like, I just need someone to just filter through the noise and tell me what it is. I don't need, the Canadian media, the CBC, to tell me how to think. I just want to know what is the truth and basically try to make money off of that.
So Steve, I'm guilty of romanticizing the financial services industry. So this is my disclaimer, but I really agree. I think so. The way that it's being agnostic, I think, is so important. Keith always harps on this, and I think he's right, which is to say it's not about what should be, it's about what is. And in order to have that assessment, you need to be dispassionate and sort of just assess. The other thing I'd say, I definitely try to seek the truth, whatever that might be. Again, forgive me for romanticizing my life's work. But the key thing for me, the most important thing, I think, and I don't know if Keith will share this view, is if you're wrong, you have to change your mind. If you have you have some kind of a priori assumption about an economy or a stock market or an index or the dollar or interest rate, and you are shown and you do research, you need to just admit that you're wrong, pivot, and move on with your life. And I find my big beef with politics in general is that there is no room for that. And why I love markets is because if you don't admit that you're wrong and change your mind, you go broke and you lose clients and you lose money. And that's, I don't know,
skin in the game.
That's skin in the game. You just have to change your mind when the data changes. You just have to. That's it. I mean, I don't know, Keith, if you have.
Well, I think what's really great today for everyone is that you now have access to information and thoughts and ideas that can help you change your mind. So right now in December 21, that's out there. You just have to turn on your device in the morning and you have immediate access to it, such as the Loonie Hour, Loonie Show. What are we calling this?
The Loonie Hour.
Loonie Hour. Okay, there we go. And however, let me tell you a story. So back in 2004, I was in Zurich. It's for a CFA conference. And by the way, do you know why Zurich is spelled with a Z?
Go on.
It's a snoozy town.
There it is. There's the boomer joke.
Yeah.
At least one per episode. Everybody gets one.
You get one.
Okay, continue. So you're in Zurich.
So yeah, absolutely. And it has to tie in with this conversation. So like, and again, I'm at this place. And the guy I'm sitting next to was one of my great mates, a Canadian, and he's with one of the big banks at the time. And I was living offshore, so I wasn't in Canada at the time. So we're going through the list, who's presenting. He said, boy, I can't wait to listen to Abby Joseph Cohen. So if you don't know that name, she was with Goldman. She was head of research. And she made her name during the tech bubble. Like she was like raw equities all the time and whatever. And I'm looking at, I'm like, I don't care about her anymore. Like she wasn't able to change her mind and she's mainstream. I said, but this other guy, I really want to hear him. I heard of him before, but I don't quite know who it is. It was Mark Faber. So if you guys remember Mark Faber. Yeah. And so he took the stage for his thing and he just killed it. I said, this is when I was introduced to global macro. He started talking about things I've never even considered before. And he stuck out like the sore thumb compared to everyone else. And what really made me appreciate, it doesn't matter whether he's right or wrong, my view is that he was forcing me to think differently. One of the last speakers was, I forget the guy with, is it Euro Group? Brenner. What's his name?
What say that again?
His surname is Brenner. I forget his first name now.
I thought you were going to say like Peter Schiff or Martin Armstrong or something.
No. I forget that guy's name. Anyway, and he's wrapping up the conference and he basically, starts knocking Faber, call him, this guy, he doesn't know what he's talking about. And that's when I knew. I said, wow, like, because these guys were representing mainstream views and thoughts and all that stuff. And then here's a guy that goes against the grain. And the mainstream side of the business, they were very anti him. Like they were telling you, don't listen to anything outside that what we're Ian Brenner. That's his
I
name.
know that guy.
Ian.
That's right.
Yeah,
That's right.
yeah, absolutely. And anyway, that's what happened. Now here we are, like 15, 20 years later, what we're coming up to. And now you have so many other like Mark Faber type guys, the guys with original thinking, different thinking you have access to. So now, as Rich said, the hardest thing to do in the investment world is change your mind. It is so hard. It really is. However, once you do it once, it becomes easier to do. And so, for example, like I wake up every morning and with our team and say, okay, what has changed? Convince us that our view on this market has changed or on that market has changed. And if it's and you never get like a black and white decision. It's like, oh, wow, yeah, we have to change. I think things happen gradually, but if you can line them all up, you can see, wow, this tide has turned. Like we've been talking about with the Fed, with raising rates, of course. Like I think that's one of the biggest stories of the year. So anyway, there we go. You got the story, right?
Hey, I got probably my name initially getting super popular. It's just I was the Canadian housing bear, selling real estate, but probably bearish. And I think over the last 15, 16 months, I've been the biggest bull in the room. And everyone's, oh, this guy's a shill now, changes in my hands. Like, hey, man, like price action speaks for itself. I mean, which we'll certainly get into because on this show, we decided to spice things up here for the listeners heading into 2022. We wanted to touch on what are we calling it? The over-under show. Basically, the one event that we each get 2 picks. We get to pick one event that we feel is going to be a high probability event and a low probability event. And so I don't know who wants to start it off.
Well, in my house, whenever we do anything, we always say the youngest goes first. So my daughter always gets to go first on stuff.
Okay.
No, it was naturally can tick some of us off.
I like
you
that.
Get the first choice of the food or something. So
all right. Well,
so I guess I'm not first, right?
I will.
I think that's you, Steve.
Yeah, no kidding. Keith's got about 80 years on me. I'll start. I'll keep it. I'll stay in my lane here. I'll stick to the as we just talking about the housing front. So I think I've been writing about this quite a bit in my reports recently, which mostly focus on Vancouver. But even from a national perspective, I would say that a high probability event. I think the condo market is actually going to outperform the single family detached housing market. So if you looked over the last, basically throughout the pandemic, is what happened is everybody's been looking for more space because you're working from home. And so the single family housing markets outperformed, particularly in the suburbs, right? People have been migrating away from downtown workplaces, going to the suburbs, buying larger homes. And that's really, really inflated values where, since the pandemic, it's not unreasonable to see houses in some of these suburbs are up 40 to 50% over the last 18 months, which is obscene. And it's getting to that point now where I think you have really overvaluation, prices are too high, or it's like the spread doesn't make any sense. And I think people, similar to the last housing bull market we saw here in 2016, what happens is that detached market gets so expensive, so competitive that it actually ends up pricing people out. And so that ends up falling and filtering down. So people say, okay, I can no longer afford this detached house. I must go one lower. And that's the townhouse market. We've already seen that price inflation in the townhouse market. Then it goes one lower and say, okay, I get priced out of the townhouse market. I just got to get something. I got to get anything. I just got to get in, because if I don't get in, I'll never get in. So if I can just get in 5 years, I'll lever up and get my detached house then. And so what happens is then you start to see the condo market outperform. And we saw this in Vancouver in 2016, right? I mean, the detached housing market peaked out in 2016. I would say prices actually were flat to down in 2017. Yet condo prices increased 20 to 25% that year. So that's kind of my prediction for a high conviction bet in 2022.
Steve, I have a question for you. is a condo a good investment overall in terms of, because you have to pay your condo fees and everything on a regular basis? But in terms of a just a standalone house, if you want to get in and out and flipping, is there much of a difference going condo versus just a regular house?
Okay, that's a good question.
Do you know what I mean? Is it a stupid question, or are you?
No, I
is
think
it
it's a really good question.
Yeah.
It's a really, really good question. Personally, I'm probably like Rich. I'm a bit of a free market, right? More. I just like, I like the freedom of like owning your own asset and like having land. I think that's where all the value is. I don't like being at the helm of a condo strata board telling me what I can and cannot do with the property. Now, don't get me wrong, I still own condos, but
You're
it's
at their
been a good
mercy.
You're at their mercy. Like, I look at some of these, I go through some of these balance sheets, these strata documents, and I go, okay, they're undercapitalized and they're mandated by the governments. So they're like in BC, right? You're mandated by the BC government that if you have a contingency reserve fund, so for example, downtown Vancouver, you're in a high rise, they have $1 million contingency fund. They are mandated to have that contingency fund of $1 million parked in basically bonds and GICs. What's like you're earning, so you have $1 million contingency fund that's earning you less than 1% per year.
Did you say bonds?
Yeah.
Did you say the bond market? That settles it. I'm not buying a condo.
Right, less than 1%. But like, think about it. Like real estate materials and labor to repair these buildings is going up 5-6% a year minimum. So in Vancouver now, Vancouver and Toronto, historically, condos have been a very good investment. Now, again, if you go to Calgary, where I have some investments, I don't have condos there, but you can just build condos forever. You can just keep going and building out more and more. And condos have been the worst investment in Alberta over the last 10 plus years. So again, perfect world. At least I can say in Vancouver, there's actually nowhere to really build out. So you can't really build more new single family communities. We don't build new single family houses. So we have to go up. And so I would argue that's why there's still some profitability in the condo market. But over a long horizon, detached housing will do significantly better.
Okay. So Steve Saretsky says, go long condos and short single family dwellings in 22.
On a short-term basis, yes, I think those will outperform in the short term. Over the long run, you're going to be much better off in a detached house. However, so now getting to my low probability event, sticking with the Canadian theme here, we talked about this at the beginning of the show. Correct me if I'm wrong. The Bank of Canada, so the market is pricing in the Bank of Canada to raise rates by 5 times by the end of 2022. So by the end of 2022, the overnight rate will be 5 times 25, 125 basis points higher. Is that correct? So I will take the under on
in
that.
my mathematical world, that is it's close.
I will take
pretty good.
I'll take the under on that. I think that's far too optimistic. I just don't think that they're going to get anywhere close. I think they'll probably, if I have to take a stab at this, I think the Bank of Canada will get 2 to 3 rate hikes in 2022, and they'll get stomped out. Mm-hmm. Who's up, Rich? You're next.
All right. So let's just to recap. So we're going to give 2 sort of predictions. One is a high probability event. So what we think is extremely likely to happen, right? And then a low probability event, something that's maybe unlikely to happen, but possible. I think that's right. So my high probability event is that the Democrats in the United States, let me give some. So there's going to be a midterm elections on November 8th, I believe, in 2022. So every 4 years, there's obviously a presidential election, and every 4 years, but offset by 2, is something called the midterms. People don't know. There are 100 Senate seats. There's like 530 odd congressional seats in the lower house. And Senates have, 6-year terms. Congressional representatives have 2-year terms. And so you have a midterm election, and it's you're sort of looking at you're just testing the waters with respect to policy decisions. And often, I mean, I guess maybe it's a high probability event that I think the Democrats are going to get absolutely trounced, and they're going to lose both the lower house, the Congress, and the upper house, the Senate. And why is that important for me as a strategist, as a markets guy? Because for me, what I care about is gridlock. So firstly, why do I think that it's highly probable? Number one, Donald Trump's approval at his midterms was 37%, depending on who you ask. Biden's is 42%. So definitely within, you're very close to basically Donald Trump's approval. So, I mean, the media likes Joe Biden. I'm not going to get into that, but the reality is that, he's not doing much better on the approval, right or wrong. I mean, I'm not interested in why. I'm just interested in what is. And the other thing is, I think that the Democrats have overplayed their hand. I think people, and everything that I've read, everything I've understood is that people don't necessarily want, extremely leftist policy. What they wanted to do is get rid of Donald Trump, and they executed on that. And now I think Democrats, having the lower house, Senate, and the the executive branch, they've overplayed their hands, and they've tried to push a lot of stuff. I'm not going to get into the politics. You can look it up yourself, but they pushed a lot of stuff that just frankly people didn't want. And I think what's really, really interesting now going forward is how that midterm election plays out. And so why do I care? Because gridlock, I think, is bad for markets. Historically, there's been a lot of research people have done for this. When you have all three houses, the most important economy in the world, all sort of pulling together in the right direction. You may not like that direction, but that's irrelevant. It's that they're all in the same direction. You generally have sort of clear policy vision. You have some kind of, you can forecast to some degree where you think that policy is going. And that helps you sort of get some clarity with respect to markets and which sectors may or may not do well, and earnings, et cetera. When you have that gridlock and there's much, much more kind of acrimonious horse trading, it's you lose that clarity. And I think markets in general don't tend to like it. Now, again, past examples are not necessarily predictive of future results, but I think it's just something that I think is highly probable that there's going to be a switch in the Senate and in the lower house. Sorry, go ahead.
Do you want to touch on the gridlock? Just like I said, obviously we got Canadian listeners here, maybe less familiar with midterm elections, et cetera, et cetera. I mean, just to kind of chime in there, I think you're talking about gridlock in terms of what the Democrats can pass, right? So fiscal spending bills, et cetera. Obviously, I think we're in a world dominated by monetary and fiscal policy, particularly fiscal policy now, because you've already got rates at zero. Central bankers need government to run these massive fiscal deficits, fiscal spending, in order to generate or try to generate meaningful growth.
Yeah, so that's a really good point.
Yeah,
so that's the way it works in the US is you have, and it's similar in Canada, but obviously, the prime minister, thank God, doesn't have a veto. In Canada, in the US, you've got, Congress writes a bill. I mean, both houses can write bills. They submit it to one another. They basically vote on it, approve, and then it gets passed up the chain, and eventually it's signed into law. If you're my age, you watch Saturday morning cartoons, there was a great a cartoon on like ABC Saturday morning. It was like how a bill becomes a law. So I would recommend everyone Google how a bill becomes a law. It's a great cartoon from like the 90s. It's very funny. It's wonderful. Maybe we'll put it in the description page of the YouTube video. But that is exactly how that works. And the issue with the United States is if you have, let's say, that's a Republican Senate and Democratic Congress and a Democratic president, or, two of the opposition and one president, that's, let's say, Democrat or whatever it is, as long as they're not the three in, contiguous parties, the same, going all in one direction, you can have serious battles, and it dilutes any kind of policy action. It stalls the policy action. You can have government shutdowns, et cetera, that go on forever. And the clear thing for me as an analyst and as a strategist is you just lose the visibility. So whether or not you agree with the government, profligacy is irrelevant. what was clear at the onset of the Biden administration is that is the direction that the train was going. Now you could think it's bad, you could think it's good, it's irrelevant. That was the train, that's the direction it's going. And so in a sense, it was easy to say, okay, that's, for, George Bush, it was deregulation. Okay. And then there was, fiscal spending here and there and whatever it is. And so for me, it's the idea that we don't actually know what will happen with respect to the election. And if it is the outcome that I predict, and it's, you have a Democratic president, Joe Biden, and then you have a Republican Senate and a Republican Congress, then it's not at all clear what policy direction the United States will go. And that affects Canadians because of trade, that affects Canadians because of energy, that affects Canadians because fiscal spending in the United States trickles into other economies, et cetera, et cetera. But I don't know if you guys have
good. Any. Yeah. Tom Brady, ladies and gentlemen.
No.
I have an observation. So my key takeaway from Rich's high probability event, what I heard, maybe I didn't hear this quite right, but again, I'm trying to take this in here. You were watching cartoons in the 90s?
Yes, I was born in 85.
Oh dear. I was not watching cartoons in the 90s. It's just, you guys are younger. I'm just getting over that now. Every now and then I hear something and it really strikes the chord. However, but back to though your main point, real simple from my side, as you know, I expect, the Fed has turned hawkish in the US, which means they're going to raise rates, going to reduce the bond buying program that they do, which is called quantitative easing. And now, and I completely agree, Rich, that the Democrats are going to lose the House, they're going to lose the Senate, and then then the White House becomes a lame duck. I mean, nothing will get done. So now all of a sudden, and this ties into my high probability event when it's my turn. But think about it now: we have the world's biggest economy that controls, the monetary levers and all that. So monetary policy is tightening at the exact same time when fiscal policy will be tightening as well. And we know what that leads to, especially for the emerging market world. So what did you have something else, Steve, or
Rich has got his low probability event here.
Yeah, my low probability event is so what I think is possible, but what I think is very, very unlikely to happen.
Leaving Portugal.
So the Montreal Canadiens are definitely not going to win the Stanley Cup. No, I'm kidding. The low probability event is that tech repeats as the best performing subsector. So if you look right now, the best performing sector is energy, and then I'm talking about global. And then you have real estate, which is sort of financials and financials. But if you look at the industry subgroup, which is something I look at a lot to see what's sort of going on, you have a situation where you have semi and semi equipment manufacturers have massively outperformed year to date. And then number 4, and then it's energy, and then it's autos and components. And then number 4 is tech hardware and equipment. So basically 2 of the top 4 are basically some form of tech. And what I think is possible, but very, very unlikely, is you get a repeat of that in the next year. I know it's a bit kind of esoteric. Sorry that you're a little bit technical and getting into my world. But I just think, and then why does that matter for me, is I just think that this long-awaited, much anticipated, heavily debated rotation from, forgive the terminology, but from growth to value, I think is finally going to happen. Now, how that plays out, which sectors, what do you call growth, what do you call value? I mean, people in my world argue about this all the time, but I think fundamentally you're finally going to have a structural underperformance in tech and stuff. Now I know that's huge call. I'm gonna get crushed in the comments, but that's
like the Widowmaker trade. That's like being
exactly. That's exactly. So that's why I think it's a low probability event. I mean, it's very possible we have yet another year that tech outperforms, but I think if I just keep hoping, eventually I'll be right.
Hey, Steve, can't you just picture Rich and all of his friends here in the locker room this afternoon, having the argument over which nerd subsector is going to outperform?
Oh,
nerds!
Nerd alert!
It's true.
It's all about.
Oh, boy.
No, but I mean, it's just been a long time, right? People have been, I know people are going to say, oh, like people have been talking about this for literally years, like since 2015, there's been, oh, the rotation. The truth is inevitably these things do somewhat mean revert. I don't mean it's going to collapse back to 2000 levels in relative performance. I just mean you just have other sectors that have been over the last few years unloved, that have strong balance sheets, right? Keith's right. I mean, you have a situation where you have monetary policy getting tighter, not looser. You have fiscal policy likely to get tighter, tighter, more restrictive, not looser. And I think in general, I think balance sheets will start to matter again. I think companies that have strong balance sheets, strong margins, that aren't necessarily tied to this cap rate, long duration game, which is basically what happens when, and that's basically a lot of tech, right? And I know there's lots of good tech, so I'm not trying to talk about that. Apple has excellent margins and excellent balance sheet. And that's not what I'm discussing. I'm talking about the more speculative stuff that's been, you can relate that to the cap rate game in real estate, right? And so that's my angle on the low probability event.
There's lots of, but there's lots of great studies out there that shows sector leadership and performance during periods of central bank rate cuts and then central bank rate hikes. And what's really great now is that we've gone through probably 14 years without experiencing a period of rate hikes. So again, I think it's incredibly important. So a lot of institutional money out there. If you're running if you're on an institutional desk or you're running that kind of money, you're always in equities. So you never decide, hey, let's get out. Because remember, that kind of money is very different than what mom and dad are running, or people listening to us here today, because we have a very definite lifespan. Some people might have 20 years productive years left to do stuff, but these guys, they look at it in decades and centuries and stuff. So what they do then, they're always swimming in the equity pool, and they're going to really move from the deep end to the shallow end and stuff like that. But everyone now, they're starting to run their models to see, which sectors and subsectors, they're running. Anyone listening to this word, they're running different multi-factor models. What would happen with rates going up, credit spreads widening, inflation high, and all that stuff. And, you're able to determine which part of the market you want to be in, and that is happening.
So we've done a little bit of work on that, actually. Sorry, one last thing on that. So we've done a little bit of work. The thing I forgot to mention was both that tightening fiscal policy and tighter monetary policy is in a world of a way above trend inflation. And that's just something we haven't really had in decades, basically. Sorry, that's my little last bit.
Yeah, it's going to tip a lot of money over. Yeah, that you can easily see that happening. And
it's going to be fun.
I love this market. I think it's so crazy and awkward, inconvenient, whatever word you want to throw at it. However, it's happening. We can't stop it, and it's just going to create some really great opportunities here coming up. So, which goes back to the earlier part of the.
Keith, hit us with your wisdom here.
Yeah, but remember earlier we were talking about being able to change your mind and your perspective and stuff in markets. This is it, guys. This is happening right now. So, which does not lead into my high probability and low probability, but it's I think they're pretty important. First of all, the high probability event for 2022. I'm going to tell a few more stories. I know that's going to happen. We can guarantee that.
Grown.
That's
okay.
Everyone's favorite. You're good for at least one good story per episode.
I know. I won't tell any more today. But my high probability event is a major emerging market country or economy is going to experience severe financial stress. So similar to what Turkey is, what's happening in Turkey right now. I think the conditions are set up for somebody else to experience a pretty severe event, and then that'll have knock-on effects as well. And I'm not going to go all the details. I think we've already bantered them around. But when you have all the central banks starting to raise rates, especially with the U.S. starting to raise rates, and it's always a relative game. So if the Yanks are starting to raise rates, and then everyone else has to do it, to keep up with them. It just sucks money out of the world. And then you have, a less fiscal spending coming out of the US side as well. I think the screws are really going to be turned on somebody. And so that's going to happen. Again, I think that's a high probability event. Do you guys want to, any additions to that, or?
You mean outside of Turkey?
Correct.
So okay, cool. Yeah. So you guys called that right. I mean, yeah,
emerging.
Really,
Yeah.
I read your article. I read your note from a year ago or whatever it was, and it was like spot on. So that's good for you guys. But I was just making sure it was outside of. We're gonna get another one basically, and probably another one after that.
Yeah, because there's
Keith,
not
it all
one
ties.
roach.
Go ahead.
Right? Yeah, there's not one roach.
Well, yeah,
right? One. Yeah.
What's all tying into your earlier comments, right? With Reg and whatnot is the uncertainty around. We've got the hawkish Fed, and then the uncertainty around fiscal as well in the U.S., right? And so that's just going to create, I think, to summarize for the viewers, is your sort of thesis is it's going to create more uncertainty, stronger U.S. dollar as that safe haven, which is going to put stress onto these emerging markets.
And it ties in with Rich's low probability event. We talked about, really sector rotation. That's what we would call it. So you're moving away, we would call high beta sectors or growth areas to more value, which means more defensive sectors. The emerging market world, whether it's in the credit market or sovereign debt market or equities, that's high beta. So you could, like the biggest joke every year in my world is every January, everyone is super bullish on emerging markets. Put your money in emerging markets, and that year end is like, oh wow, that's a head scratcher. Like, for example, I was looking at the Hong Kong market this morning. It's now at its 5-year low again. Like, it's just, unbelievable. You wouldn't think that. Everyone else has just been screaming higher, and in this market,
Hong Kong is bust though. Hong Kong is bust. I mean, sorry to interrupt you, but what's going on there is just a complete.
Didn't they just shut down another major newspaper company, right? Media company. Gone.
Yeah, they got
permanently
a few
closed.
things. Yeah. I don't think the Loonie Hour or Loonie Show, I still don't know which one. We wouldn't survive over there, lads. It wouldn't work.
Yeah, that's crazy.
So, but what I liked about this, what we're doing here today, I find everything is connecting, one with the other. So that's pretty good. And then let's look at the what's going to be our
low probability event.
Yeah, lower probability event. So for I've been banging on these guys for a long time. I like to call it the economic fantasy land called Europe. I think it's not only a low probability event, it's a zero probability event of the European Central Bank raising rates. It just ain't going to happen. So, there are different ways to play that, but with everyone else in the world raising rates or talking about raising rates, these guys can't do it. So that has other investment implications as well as you spread around. So I really, I look at my two events and I like both of them. I think I'll be right on both.
I hope you are. You're managing my money, so.
Are we going to do the most interesting, or do we have enough time for that?
Well, I was going to comment on that, Rich. Can you confirm? I know parts of Europe, but I mean, aren't these guys blowing massive housing bubbles over there? Like, I know Germany's got a huge housing bubble right now, right? Like, I mean, bubble in relative terms to the Germans.
Yeah.
I mean, in Canadian terms, it still looks very healthy, but.
Yeah. So bubble, who knows if it's a bubble, right? It's always kind of an ex post thing. You look back and say it's a bubble, but Germany's housing market since 2010 has doubled. Yeah. I'll show that chart. It's doubled. I mean, the same, house prices in Netherlands are up 25%. In France, you're getting, 10% year on year growth. I mean, even in Spain even Italy, which has been abysmal for years and years and years, you're finally getting, 5% housing growth year on year, which is for them, that's a big deal. So yeah, everywhere.
I'm just pulling up. Did you guys see this? Did you see this article? It was in the Ireland Times, Irish newspaper. It says they've now unrolled or unveiled mortgages at 7 times salary for the first time since Northern Rock.
Oh boy.
And of course, if you're not familiar with Northern Rock, I believe it wasn't that bad. Didn't they go under? It's in the financial crisis. Ireland blew this massive housing bubble.
Well, Northern Rock was the UK bank. That was the first one that had the bank run. So
Right.
it's infamous because you literally had the little old ladies lined up in the rain, waiting to get in to yank their money out. So I think that took place around the same time as pretty close to when the Bear Stearns funds first went under. So
it's crazy, eh? That's I mean, good point. Speaking of which, because everybody, of course, it's always too late when you line up at the banks to go get your cash. I went into the bank in Canada the other day. Don't ask why, but I went to go pull $5,000 cash. I had to pay a couple tradespeople, and the guy is like, "Did you set up
wait, are you saying you're in a cash business?"
It's okay. Canada's the best country in the world to commit white collar crime. You get my ask, and you're from British Columbia. You know all about that.
I said I had some Christmas.
We're gonna get in trouble for that one.
But anyways, I went to go get 5,000 cash, and this guy, this banker was like, "Oh, 5,000 cash." He's like, "Sir, did you set up an appointment? We might not have 5,000 cash. If everyone came in here demanding 5,000 cash, we wouldn't be able to, And he was going on this long spiel. He's very upset that I just walked in and asked for 5,000 cash. But I coming back to Northern Rock there, the little old lady, right? Everybody just assumes that, banks, safe money and you can just pull it out whenever. I mean, in Canada, we have a little known, what is it? Was it $100,000 is insured, but there's also in Canada we have called a bail-in program. You guys familiar?
I did not know. No, I did not know this.
Keith probably knows.
Yeah, so I used to cover the global financial sector when I was offshore, so I can swim around the balance sheet pretty good on the bank side. So I mean, first of all, with banks, they're levered entities. So whatever, physical cash is just not used that much anymore anyway, especially in Canada. And we've really moved to that electronic side of the world. And then, of course, we always had that term, you get bailed out. And, no major Canadian bank has ever been in a position in our lifetime, really, where, they had to get a bailout. I think maybe early 90s, Royal Trust back then ran in, some of the insurance companies ran into problems when the real estate market popped, because their balance sheet was full of that stuff. But in terms of the big 5 plus 1 or 6 today, we don't have that. However, because of the situation in Europe back in 11 or 12, I think it was, when they decided, we have to bail out, the Italians and then the Spanish and so forth, and the Portuguese.
They bailed out the Germans, but that's an episode. That's a conversation for a different day. They really bailed out the Germans. Well, that's just it.
Yeah, absolutely. The money went in and then out again, right? That's what happened. And they got a big backlash for that. So instead of having a bailout, they do what's called a bail-in. That's what happened in Cyprus. So for Canadian listeners, what that means is if you're a bank, and again, there's nothing out there right now to suggest this is happening. So we're not scaremongering at all. Just explaining
good.
So please don't think Steve Saretsky is telling you to yank the money out of the bank, right? But the big difference though is what happened, and then the Canadian government, then a few years ago, they actually adopted this. It's in the fine print somewhere. Steve's friends in Ottawa have all that information. Steve's an insider, right? You know all that now.
Yeah, I'm an insider now.
But what happens though is instead of using public money to make the bank healthy again, which means you can get your money out, they would take your money that's a deposit and that's used to bail out people who lent money to the bank. They still have that $100,000 insurance policy basically for depositors, GICs and stuff. But that if you have $110,000 on deposit, then that $10,000 becomes exposed or vulnerable, to that bailout or bail-in, as they call it. And it's because these banks become too. So if you cannot have one Canadian bank have a bank run, they're all the same. You can look at their balance sheets. You're splitting hairs. They're all in the same real estate markets. They're in the same commercial lending market, it's the same credit card market, wealth management products. I mean, the only difference is the color of the shirt that you're wearing.
You're so cynical, Keith. How
that's not, that's just being objective. Right?
I'm kidding. I'm kidding.
Yeah,
You're right.
I
Of
mean,
course you're right.
Whereas if you go down to America, you have like 4 to 5 really big banks, and then like you literally have hundreds of
there's thousands
banks.
There's thousands of banks, and there's 6,000 banks in the US.
Absolutely, and that's not a bad thing, right? This is not a bad thing. So in Canada, if we do have some kind of event, the entire industry will just get walloped with it, and the government cannot bail them out because they won't be able to access money to do it. Because remember, with the Irish, for example, you go back to the Irish when the 0809 crisis went down. The Bank of Ireland, they're one of the big ones, and what's the other one, Rich? The other Irish bank, AIB,
RBS.
No,
I thought it was
Irish,
RBS.
No, that's the British bank. The Irish
sorry,
bank.
but they owned a lot of British assets, Irish assets, which is why I thought.
But what happened though with the Irish banks? They got in trouble, and like the next morning, the Prime Minister in Ireland, he said, "We're crossing the line right here. We're going to protect everyone's money. You don't need to worry about it." And I love the Irish because they're, when they talk about
like
things
the worst
with
thing you can say,
confidence,
isn't it?
No, I like the Irish, and but when they make an announcement, they say it in such a way with such confidence. You look at them, and if you don't know them well enough, you say, "My God, they're right." But if you do know them well enough, which in the money world we do, you know that they don't quite have the whole story. So what they were missing was that they were guaranteeing then Irish debt that Ireland could continuously borrow to backstop their banks. And so A, they didn't realize how big their banks were. And B, they suddenly realized, oh my God, they can't borrow anymore, because all of a sudden their rates went from 2-3% up to 10 or 12%. And they had to go running to the EU to say, now we need a bailout. It all went circular in the end. So that's where you have like the Troika, they call it in Europe. So you have the ECB, the European Union, and the IMF had to step in, and that's where they bail out. They call it the pigs, of course, right? So Portugal, Ireland, Italy, and Greece, and Spain.
I'm offended by that comment.
Which one?
Quick plug though, if anyone wants to have like a more thorough breakdown of that whole unfolding, fantastic book by Michael Lewis, who wrote The Big Short. He wrote a book called Boomerang, which is a fantastic book on sort of that financial crisis, and really talks about some of these markets that just blew up spectacularly. I think he talks about Iceland and Ireland, of course, which just suffered immensely.
I have a story for you.
Okay. Well,
back in very quick. So back in my Bermudas, I was getting headhunters call me like to go back to Canada all the time, and there's one guy calls, I represent one of the Icelandic banks, who's Landesbank, and they said, we want you to go to Canada and sell our ICE savings account product. And I'm like, well, what is it? He said, well, it's a savings account. We pay out 5.5%, 6%. And I'm looking, I'm thinking, how does that even happen? Like everyone is at 1%. How are you guys doing 5 or 6%? Oh, we have financial ingenuity, innovation. We've been fishermen for centuries, but now we really know banking. We figured it out. Anyway, I turned down the job, of course. I said, this ain't going to work. This ain't going to work. Then everything did fall apart, like 18 months later. But it's all tied together.
Smell test. How are they? Do you know?
Yeah.
Sorry. How are they actually engineering that yield?
Well, so they take their money on deposit. So they have to, if you give me your money and I have to pay you 5%, I have to earn more than 5%.
So they were just taking a massive risk, basically, is what you're saying.
Yeah. So the way you earn more than 5%, you either take on a lot of credit risk, and or you leverage that up even more. So that's what they're doing. They're levered on poor credit. So then when the cards started tumbling down, which did happen, of course, they got shut out immediately. So that's
Speaking of contagion, systemic risk and whatnot, I just found it interesting. I was reading a year-end report from BMO. They always put out a mortgage report in Canada, like a very in-depth one. 50, I didn't realize it. I mean, I always knew it was high, but 50% of all residential mortgages in Canada, like 50% of outstanding residential secured lending in Canada is in Ontario.
Sorry, can you repeat that slowly?
So you got the big 6 banks in Canada, right? So of all the secured residential real estate loans in Canada across these big 6 major banks, 50% of their exposure is in Ontario.
So if Ontario got into trouble, the banks.
Basically, what I'm saying is you can almost make an argument that if you're looking for signs or wobbles, like the Ontario housing market is basically systemic at this point. It's like
the Toronto housing market, like the greater Toronto area, is systemic, is where it really boils down to, right?
Realistically, yeah. I mean, it's basically 50% of all
now
real estate loans.
Just to take the other side of that argument, because clearly we've already talked about this, and I agree with you on the whole. But isn't Toronto like 25% of Canada's GDP and Ontario like 40% of GDP? You know what I'm saying? Like, don't get me wrong, it's totally nuts. I get it. I mean, it's it's just like income and blah blah blah. But to take the other side of the argument, maybe it's not as crazy. Don't get me wrong, it's clear we have too much debt.
I agree. I'm not saying that just from a population perspective, but it's like almost like so at some point it's like, we talk about these like national home statistics and blah 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 blah. It's like really like the only 2 markets you have to focus on are like Ontario and BC.
Yeah,
because BC is actually not, BC is number 2 in secured loans exposure across the big banks. But it's really like nobody talks about. Yeah, nobody talks about like Saskatchewan, Manitoba, Alberta, like this. It's like a non-story. It's like if you want to focus on like systemic risks in Canada, like you pretty much just focus on those 2 markets. And that's really why, like, I've got a Yahoo Finance show, and like all we talk about is Vancouver and Toronto. That's it. But the best value play, I think, in Canada in terms of real estate is probably in Alberta, personally.
Crazy. Can we I know it's not my place to say, but can we, before we wrap it up, I really want to talk about just something we thought was interesting, if that's okay with you.
Keith, who's starting first? I don't want to go first.
No,
Rich, go first.
I love how Rich is so bashful. Like, can we kind of talk about numbers?
I just know the one thing I really want to just throw in there as like the grenade for 2021 is that the thing that was most interesting is everybody realized that fossil fuels are super, super important in Europe.
That's a good one.
And I needed to just do that. I need to throw it in there.
I posted your chart again on Twitter yesterday. I got in a fight after a couple drinks, which was a mistake, with a climate change activist. And so I posted your chart on oil. But
I'm sure it was an objective discussion. I posted a piece from I went to a dinner party last night with some friends, and my friends are really good, like a pit master. So we cooked this big brisket last night, and I posted it. And guys were having like big discussions on what kind of knife you use to cut it, whether it was a bread knife or a steak knife. That's what Twitter is, right? It's just really great conversations. But back to Rich's point, though, Rich, I think you are right. That was an incredibly keen observation, not by you, but by what's happening. But very few people, I think, really appreciate how important it was, and it is going to continue, I think, to drift over into 22.
Like, not to over egg it, but like it sort of popped the whole green bubble a little bit. It just like showed everybody that like all these super aspirational things. And again, not making a value judgment. All I care about, I'm agnostic to climate change. I'm agnostic to all this stuff. All I care about is, are these promises realistic? Yes or no? And can you make money going either way on that trade? And I just think it was it exposed it. So I needed to throw that in there.
I agree.
So my maybe not my most, but I think one of the most interesting market events I sort of saw last year. I think over the last few shows I always mention it, but we never had a deep discussion on. But really, it's these ARC funds, this Cathie Wood funds, and I mean, from their, you look at the flagship fund, from the peak in February to current, it must be down 50%. I think. I'm just ballparking the actual number here. But the reason I find it so interesting, because again, we talked a lot of money's been flowing in these high beta type plays, which is the tech market and so forth. But what makes this fund, what makes it catch my interest and a lot of other people as well, that it's attracted so many assets into it, but a lot of the positions in the fund that they're really illiquid. So the way that she gets liquidity in the fund, because remember I mentioned earlier, if you're managing equities, you're always in equities. Like you don't set money aside for cash, because that's an asset allocation decision which you make outside of that fund allocation. But within her fund, she gets liquidity by investing in the big cap tech names, the Apples and Teslas and stuff like that. So you can see how those funds can quickly start tumbling down, because if people all of a sudden decide, you know what, I made money this year, I got to close this for tax reasons or whatever, one event triggers the other and it comes down pretty hard. But so I'm in a regulated industry in both Canada and the US, and I can say certain things and I cannot say a lot of things. But she made a statement last week or the week before, I don't know if you guys caught it or not, but she said the fund should make 40% annual returns over the next 5 years. And I'm reading this, I think, are you kidding me? If anyone else even suggested that, you're getting a knock on the door that afternoon, you're getting fined and censored and all kinds of bad things are coming your way. She just retracted the next day, changed the letters she wrote, and I haven't heard boo about it since. So for the regulators that are listening, you might want to knock on Kathy's door and find out what she's saying. But again, it's the whole ARC funds and money chases returns. But that thing is pretty big, and that fund in itself, can be like an event from Turkey, for example, or emerging markets. It could be one of these events that triggers money to run to some other part of the market. How about you, Steve? What caught your attention last year?
Yeah, I think as the the youngest guy on the show here, I'm going to take the lead on I think the most interesting is the emergence or the mainstream adoption of the crypto space. I don't consider myself an expert, but I've been following it. I got into Bitcoin in 2018, post a big sell-off in 2017. Just slowly was dollar cost averaging, and I've been kind of following and tracking the space just with interest, because I think there's a lot of interesting use cases that will emerge over the next 3 to 5 years. And trying to follow more and more people in that space that are much smarter than I am. But I just think it's very interesting to see. We haven't done a lot of discussion on the show about it, but Canada, for all its lack of ingenuity and productivity, etc., is actually leading the charge in many respects in terms of what's happening in the crypto space. A lot of good companies are being born here in Canada. We've of course got looser regulation. So we've seen Bitcoin ETFs, Ethereum ETFs have actually been started in Canada. They're still not approved in the US. That's been an ongoing debate with the SEC. And so, I think that's kind of the thing that I find the most interesting. I think it's, Rich, we talked about this pre-show, but I think it's a space where, people have to know that it's definitely a high risk, high reward asset. There's going to be some coins and tokens and NFTs and stuff that go to zero. Feels very much, I wasn't active in this part, but people sort of signal it as the sort of the .com boom, right? I mean, a lot of fraud happening and stuff like that. But I do think there's going to be some really good use cases, and there's going to be a lot of wealth, I think, that is created in parts of that space. So that's kind of what I'm most interested in right now.
That story was huge. I mean, it was, everyone's talking about crypto and they use Bitcoin as the generic phrase for it, of course. But what I like about it now, though, I think a lot of the euphoria that we had in the first half of the year, that's largely gone, because I don't hear people talking about it too much anymore, unless you're in that echo chamber that exists for everything these days. So I think the more that it settles down, the more it has the opportunity to maybe become a component of people's portfolios out there. So I'm not
Yeah,
saying
there's
that, I'm not saying
actually,
it should be or it shouldn't, but it has to grow to that point where it's been
Boring.
adopted. Yeah, absolutely. Like it's no longer like the number one thing out of your mouth when you talk about markets, because there's always a cool market out there to make or lose money in. But that was definitely an attention getter. A lot more interesting than what did Rich talk about again? I even forget now. I don't know what it was.
The energy crisis.
Oh, the energy crisis. Sure.
So one thing
Yeah.
on Bitcoin, I think I agree with you guys both ends on your kind of summary, Steve, as usual. You did a really good job. And then on Keith's sort of more pragmatic approach to it, I was just going to say, I think to me going forward, I mean, the word that I think people are afraid of is, to me, the big green light. You double down on it is regulation from the US. I think as soon as they start regulating it, I think it's off to the races. I think in a perverse way, the more you regulate it, the more boring it gets, the more uninteresting, so to speak, it gets, and the more attractive for me personally it would get.
So if you're a regulator, but if you're a regulator right now, you're always looking, okay, what can we touch next? And if I'm the regulator and I see this crypto market come out of nowhere, I'm thinking, I want my hands on that. And what people don't realize in the investment industry, there's not one regulator. There are a ton of regulators out there, right? And each one is fighting for control over one turf over the other. And so a key thing with the whole crypto space, there are futures markets on it now, of course. So that leads it over to the CFTC side, away from the SEC. If you're getting bored with that, then it's something you should be aware of. But the more regulators do get involved with something, they do it to try to protect investors. That's the main reason for doing it, and they do provide a lot of great policies for that. But it does provide more.
And this is a conversation
for another time. Sure,
for another time. We'll expand on this. We'll wrap it up here. But I will say, just to kind of quickly, last sort of comment on this is, regardless of your views, again, trying to be agnostic about how you feel about cryptocurrencies, Bitcoin, Ethereum, whatever, it doesn't matter. Every central bank is working on a central bank digital currency. Every single one of them, even the Bank of Canada, which is probably years and years behind. I think that's where we're going. And, we've talked about, great resets and what is money, and central banks becoming married with the federal government. It's all going, I think, in that space, and central banks are actively looking at it. So I think that it's going to form a part of our financial system in the years ahead. So, but we'll get into that in a future episode. This has been a splice, as always. Happy New Year's to all of our listeners. We went a little bit over time for today's show, but hopefully a little treat of what's to come in 2022. God bless, and thanks for all your support.